following is paid programming. Welcome to Something More with Chris Boyd, certified financial planner practitioner and founder of Asset Management Resources, LLC, a registered investment advisor firm. We call it Something More because we like to talk not only about those important dollar and cents issues, but also the quality of life issues that make the money matters matter. Here he is, your fulfillment facilitator, your partner in prosperity, advising clients across the country, your host, J. Christopher Boyd.
Welcome to the podcast. Thanks for being with us. I'm Chris Boyd, certified financial planner practitioner. I'm here with Jeff Perry, investment advisory representative, and Brian Regan, our firm's chief investment officer, all with Asset Management Resources. Thanks for being with us. We got a lot to talk about when it comes to the markets and what's been happening. What are the drivers? We're going to talk a little bit about the economy and the markets in this segment. So Brian, always love to have your input on this because you have such a good read on all the data and what's happening. Where are we in the? We've seen the markets moving a lot the last few weeks, last few months, and what's happening? What's going on?
Well, the biggest driver of the markets over the last couple of months has been this rapid sell-off that we've had on the long-term Treasury market. That if you've seen the 10-year that just go from the pretty stable between 360 and 4 to this eruption closer to 5% over the last month has been very surprising. And an increase in long-term Treasury rates is poisonous for stocks. It's just poisonous. The riskier the stocks are, the more poisonous it is. So we have been experiencing this little bit of a sell-off. And the reason why the 10-year has been so aggressive, at least the only reason that I can surmise, is that the expected GDP growth for Q3 is expected to be very high. And this has implications for what the Fed will do, and it will have implications about what will happen in the future. I mean, will this very high, right now the Atlanta Fed expects 4.9% GDP in the third quarter. Will that persist or won't it? The bond market right now is saying this is going to persist. And this is a follow-on to what the Federal Reserve came out with last week, where it showed that the dot plots, the expectations of where they think the economy is going to go, they expect that it's going to be stronger for longer and that they're going to have to be higher for longer. And that's all being priced into the bond market right now.
Excellent. So there's a lot to think about there. Let's talk about it. So we have heard in the news that the Fed is, sort of slowed those dot plots, and that's I guess part of this. But
don't they have to say that though? I mean, they can't. So they've had this tightening path. We're up at 5.25, 5.5.
Yeah.
Don't they have to have that position, that hawkish position? Even if they, internally may be thinking, well, I don't know, things are good. Not that good, but good. I don't know. I just think some of it's so choreographed and telegraphed that they're not going to be the dot blocks have been wrong, and their projections of GDP have been wrong. So I'm kind of done predicting what they're going to do.
Well, I mean, it sounds like they're not going to do much for a while. I think they're holding this in their back pocket about another 0.25%. But
no, I mean, I'm even saying higher for longer is a good thing to say because you don't want to telegraph a rate cut.
Yeah, that's true.
Or the telegraph a recession.
It implies anxiety. Yeah.
Right. You don't want to create something by saying we see a recession.
Yeah. And
we're going to decrease rates to deal with it, because then the whole economy and the whole market responds, right?
Yeah.
And that may or may not be the case.
Self-fulfilling kind
That's
of thing.
right.
Yeah.
So I don't know if it's just a they did pause last time, and I'd like to hear more about what Brian views as the recent economic news, but it's mixed, right? So I'm not sure I'm buying their higher for longer means higher for longer.
Really? Okay.
Yep. Well, I disagree just slightly, Jeff. I would say that the recent economic news is not mixed. It is abundantly, aggressively good. And that's kind of the problem, right? When you have a GDP forecast for the third quarter of near 5% and potential for the U.S. economy is expected to be 1.5 or 2%, The reason why the Federal Reserve is being more aggressive, at least with their jaws, not necessarily with their actions, is because they're afraid that accelerated growth will lead to inflation rearing its ugly head back again. So I think that ultimately that's a concern. I think we can all agree that as of this moment, inflation is not much of an issue. But 5% growth, if that continues in the fourth quarter, in the first quarter, in the second quarter, well, it's going to be an issue. Wouldn't
that be good to have 5% growth?
You would think, right?
Yeah.
If inflation stayed down,
yeah,
right. If it was based on productivity, perhaps, or other good things, and it wasn't.
Let's remember that when we talk about GDP, it's always a real number. We don't talk about nominal GDP. We talk about GDP net of inflation.
After inflation, yeah.
Real
GDP in the rearview mirror.
Yeah.
Right.
Yeah.
Right.
But the Fed's not predicting 4 or 5% for the fourth quarter.
No, they're expecting it to come down, and they're expecting the unemployment rate to continue to go up. It's the pace of these things that's changing, right? And when we talk about long-term interest rates, right, we're not talking about what the Fed's going to do in November, right, whether they're going to raise 25 basis points or not. We're talking about what the average Fed funds rate is going to be for the next 10 years. And right now, the market's saying that the average Fed funds rate for the next 10 years is going to be around 5%, which is very high, right? So the implied, if you look at the TIPS break-even spreads, the implied inflation expectations for the next 10 years is only 2.3%. So that means you're going to get a real yield on your 10-year Treasury of near 2.5 to 2.7%, if those numbers are correct, right? Of course, it's just the market prices of today expecting for the next 10 years. Now, in order for that to happen, we would have to exceed potential GDP by a good 1 percentage point, right? That typically you would expect the spread on treasuries to be somewhere around expected real GDP growth, and that's showing to be aggressively high, right? 2.7%. So what does that mean? Well, I think the market's taking what we're seeing in Q3, and then they're extrapolating it out. If this lasts for another year, 2 years, well, that average 2.7% becomes much more realistic. So, all that's to say, will it persist? And I have some information here that says, where is the economy doing really well? Where is the economy not doing so well? And hopefully by analyzing that, we can make some logical determinations on whether this is going to persist or not.
Before you dive into that, isn't it kind of astounding that the Fed raised rates 5+%, whatever it is,
5.25 to 5.5. Yeah.
And the economy is still banging away. It's just kind of shocking.
If you listen to Jeremy Siegel, the Wharton's Business School, professor,
Wizard of Wharton.
Yep. Yeah. No, he's still banging the drum that these rate hikes take a while. A year. 18 months.
Yeah.
I think there's some credible argument that it takes less time than it used to take because of the nature of our economy, but they're still filtering through. Businesses are probably less optimistic about making infrastructure, buying machines. Consumers have that weight of higher mortgage rates, higher car loans.
Yeah.
We've seen the debt rates be really high.
Yeah, that takes a while to
starting right now, all these student loans are due.
Right.
How much money will that take out of the economy or put somewhere else in the economy?
Yeah.
Right. Yeah. So
where it had been going, not going.
I don't know, obviously, but I'm not sure all the impact of these higher rates have been felt. Home prices are down in many areas across the country. Not every area, but home mortgages are collapsing. People taking out mortgages, and home sales are down.
Yeah.
Consumer confidence isn't that high. It's actually declining.
Yeah.
Brian made the point that unemployment is expected to trickle higher. So I'm not all sunshine and roses with the economy. And, in the rearview mirror, a great GDP. I'm glad it's good for jobs, good for people's paychecks.
All right, Brian, you had some things you wanted to say that might contradict that, I guess. So this is a
well,
good
I kind of just want to get into what the companies are saying, right? What are American companies saying about the state of the economy, and where's the growth coming from? So if you look at the personal consumption expenditures, where consumers are actually spending money, it's on housing, utilities, transportation services, healthcare. Housing, to Jeff's point, it's expected to come down as the real data starts to come in, real-time data starts to come in. The housing market's frozen. Non-residential investment is really driving the economy right now. So, what does that mean? Well, if you look at what David Calhoun, the CEO of Boeing, is saying, they're delivering planes where they weren't delivering planes a couple of years ago or even last year due to a variety of operational issues. But through the first half of this year, they've delivered 136 planes. Now, that doesn't sound like a lot, but when one of the biggest manufacturers in the United States goes from delivering on near zero to delivering hundreds of planes in a year, it's going to have a real impact on the economy. We're seeing a lot of onshoring of manufacturing or reshoring as a reaction to that supply chain threat that we saw a couple of years ago. But also, I think a big reaction to threats on Taiwan, particularly in the semiconductor industry. We know that there was the CHIPS Act there that is encouraging people to build foundries, into semiconductor foundries in the United States. And if you listen to the CFO of Applied Materials, Bryce Hill, he's saying that we're seeing a big expectation of Internet of Things equipment manufacturing for the foreseeable future. So sustained growth in manufacturing in the United States. So this big reshoring, conversation that we're having. Another place where we're really strong, and I think this is a really interesting company to listen to, is John Deere. So John Deere, for example, has seen heavy industrial equipment, whether it be farm equipment, ag equipment, or big trucks in the transportation industry, do very, very well, where retail type equipment like lawn tractors aren't doing as well. So what we're seeing is that the capital investment has been there, and we haven't even talked about AI yet. The capital investment has been there throughout the country, and I think that's driving the economy right now. Now, if you listen to a company like Costco, which is a little bit different, right? This is one of my favorite retailers. They'll tell you that foot traffic's really good. The ticket price, the average ticket is down. And why is the average ticket down? People aren't buying big discretionary goods anymore. We are in a cyclical low when it comes to discretionary purchases. So when you think about how this will resolve itself in the next year, we're seeing big spending on transportation and services. I think about this like an Uber has become significantly more expensive over the last year than it was prior to the pandemic, when it was mostly private equity financed rides that we were all taking. People jumped back into airplanes. We're back at pre-pandemic levels or close to it. And will that persist? Well, I think it's questionable whether that type of activity will persist or if it will normalize. My guess is it will likely normalize. If travel normalizes, if airplane travel normalizes, will equipment manufacturing for Boeing, for example, continue at the pace it is? Well, I think that's a question mark as well. When we see things, spending in housing and utilities, keeping personal consumption expenditures up, you have to wonder when the real-time data flows in, will we see a correction there? So my guess is that 5% will not persist, all is to say. But I do think there are some tailwinds, particularly from the reshoring of supply chains, notably semiconductors, and from the infrastructure projects that are going on all throughout the country. And I think you could see that through the John Deere data in particular.
Well, that's encouraging, I think, in the one hand, right? Like it seems like these are a lot of positives. I mean, it does sound like maybe some shift in where we're going to see favorable data. And, you know, I mean, we were talking about worries about the consumer. You talked about that. Do you want to elaborate on that, or?
Oh, I just, you know, the consumer seeing still higher grocery prices, higher gas prices as we enter winter here. Fuel oil, heating oil, and natural gas, they're higher.
Yeah.
So those are things. I mentioned student loans and consumer debt, interest on consumer debt, interest on those things that people choose to finance. They're going to weigh on the consumer. And I think the Costco reference that Brian made shows that they're still shopping. They have to shop. And Costco's a great place to save money, but they're buying essentials. They're not buying those going down some of the aisles on the other side of the store, right?
Right.
They're getting what they need.
Yeah.
So,
I think Jeff's right. And I think there are some, you know, near-term headwinds. You know, we haven't even mentioned the government shutdown that's looming. You know, historically that's only lasted a couple of days, but this is what we're all saying is money is getting tighter, right? Higher interest rates. We know that banks are tightening up. Higher gas prices means less budget available to buy discretionary type items. And I think there will be a natural recycle in the cyclical nature of discretionary items. For example, you know, iPhones don't last forever. We all typically upgrade every couple of years. There will be a natural reaction to this cyclical low that we're in. That doesn't necessarily will be in a cyclical boom. And I think watching some of these services that are in a cyclical boom, I wouldn't expect that to last either. And we also know that there's these measurement issues, particularly in, you know, things like housing and utilities that are likely to come down. So, you know, the bond market, getting back to the actual markets, the bond market is pricing in persistent economic strength. And I think that we've outlined enough reasons to think that, hey, look, 5%, I think we can agree, is probably not going to last for the foreseeable future. You know, so will we average GDP growth of almost 3% over the next decade? My guess is probably not, which means that the bond market is relatively cheap in my mind. And the question is, you know, why? Why is it so cheap? Are we missing something? Will it correct? I think these are all reasonable questions to ask.
Over the next couple of weeks, we're going to get some corporate earnings as they start to come in as we're at the end of the third quarter.
Yeah.
And we'll get banks first, right? That comes in the first week. And I think the big thing that you want to watch with the big banks are their net interest margins are going to be great. What you want to look for is what are they looking for charge-offs? Are they going to expect significant charge-offs? You know, are they on the credit portfolios in any significant way?
It's an early sign, right?
Well, you know, sometimes they take charges and the charges don't come to fruition, which happened after the pandemic. But I think that it's always something to pay attention to. It's what are they expecting to happen? You know, banks by nature, especially since the financial crisis, I think are fairly conservative when they come to, you know, expecting charge-offs. The big banks, at least. If you look at, you know, your local banks, your regional banks, as they're now called, that have, you know, great amount of office loans, you know, they'll still claim that they're all money good, which I think we all know that that's probably not true. So, you know, you got to keep an eye on these things and be a little guarded when you evaluate them. But you know, it should be interesting. What are they expecting? I'm really interested in seeing a turn in discretionary type items. You know, Nike is a stock that I think I associate as a discretionary item, and it's down like 50% from its high. It's still relatively, you know, rich from a valuation perspective, but you know, when they start to show some kind of life, well, maybe that's a turn into the discretionary goods item. Just as something to keep an eye on.
Well, we could very well see great earnings reports if the GDP's been so strong and other things that you've talked about, Brian. But
if we don't see great earnings reports, that'll be a big problem with interest rates where they are.
I'm more interested in
we need to see a trough in earnings in Q3 an acceleration going into Q4.
I'm more interested in what the CEOs and CFOs are saying on the calls. You know, great earnings. However,
yeah, what they're forecasting or
right,
how they're preparing investors.
Well, one of the things I find interesting, right? Like, so yes, interest rates are high. Let's call it 5%. But Google, for example, has a track record of growing at 20% per year. That is an easy leap over, you know, a 5% hurdle. Will they be able to continue to do something like that with competition like ChatGPT sneaking in? Microsoft is, you know, a gigantic company. They have a very strong partnership with OpenAI, for example. They're implementing it into all their products. Is that going to accelerate their growth significantly beyond that 5% hurdle? I think what I'm looking for is I want to see companies with enough growth to justify their price and justify their price against this, you know, rapid increase in interest rates that we had. It's easy to justify your price when interest rates are you know, 1.6%, but when they're at 5%, it's much harder, particularly for slow growth companies, right? What you're seeing right now is it's not hard to find a slow growth company with a dividend yield north of 7. It's just not hard to do it. Right. And the reason for that is because I can buy a Treasury security for a year at 5.5%. So, you know,
are you concerned about the auto strike and the impact that has on the economy, not just the companies involved, but the economy in general?
I'm more concerned about profit margins when it comes to that. So I think this is a symptom of a greater plague, and the greater plague is people feel as though their wages have not kept up with the inflation rate for the last few years, and only recently has their real wages been positive versus inflation. So there's multiple years worth of catch up, and we saw the UPS strike. You know, they got a significant raise. I think the United Auto Workers are going to get a significant raise, and you know, I think this is going to pressure margins on companies where we've seen, you know, margins kind of shot up over the last decade or so. They've taken a bit of a break here in the last couple of years. And if labor has a lot of power, they could further, you know, decrease the profitability of these companies, which is what I think is I'm more concerned about rather than any greater impact on the economy.
Well, I think that's, you know, a good point to talk about, just the idea that people may have challenges as they're investing, you know, and there's always so much to be thinking about when you're an investor to evaluate, particularly when it comes to individual securities and the challenges of, you know, is this stock one I should keep or something I should do differently, you know? Is that too much, too little? You know, that kind of thing.
A lot of worrying about recession.
A lot of
I think the last 5 years have been particularly difficult, right? I was talking with somebody last night. You know, how many of us remember that in 2018 we had a 20% drop in the stock market? That is a short period of time for an investor to remember, but I think for the average person, that's not fresh in our minds, right? But in 2018, we had a relatively tough year. 2019, we had a great year. 2020, we had a pandemic. 2021 was boom times. 2022 was awful. You know, it's been a tough years.
It's a bit of a seesaw, right? Yeah.
Right.
Well, and I think, you know, particularly if you are an investor who has, you know, not only just those kinds of concerns, right, but also maybe you have some legacy holdings or you have individual securities and you're like, are they good? Am I in there? I liked them when I bought them, but, you know, how do I evaluate these? You know, I don't have a sophisticated review of their balance sheet necessarily. You know, how do I evaluate, is this the right investment to retain or not? You know, you might benefit from a little bit of help in that process and talking to someone like Brian and our firm can be a resource to examine what you have, how it fits into a greater context of your financial planning and the risks that you're taking. You may be in a moment in time where you don't need to take as much risk as you may have in the zero interest rate environment. And these are all things to be considering. And, I'm just pointing out that if you need a little help in this regard, our team can be a great resource to you, and we'd love to have the opportunity to talk with you. Think about your investments in the context of your financial plan and put it all together. Make sure it's a program that works for you. Guys, thanks so much for your thoughts today. All right, until next time, keep striving for something more.
Thank you for listening to Something More with Chris Boyd. Call us for help, whether it's financial planning, portfolio management, insurance concerns, or those quality of life issues that make the money matters matter. Whatever's on your mind, visit us at amrfinancial.com or call us toll-free at 866-771-8901 or send us your questions to radio@amrfinancial.com.